A very good evening to everyone. My name is Saanvi Bhuva, and my teammates are Asmira, Shlok, Ziyan, Vasuraj, Heet, and Smit. And today we're going to present our analysis on the book The Unusual Billionaires by Saurabh Mukherjee. So the first theme is how greatness is defined. So we can define it by its market cap, but that's not an effective measure as it's an effect, not a cause of greatness. So an objective method to classify greatness is the ability to sustain superior financial performance across long periods of times across different economic cycles. So the first filter that we use is the universe. It should be a listed company so we can get the data easily. The market cap should be over 100 crores. That gives us 1,500 companies at the time of the book, but now it gives us 3,000 companies. So we need to increase the filter to 1,000 crores. So we get 1,500 companies today. The second filter is the time horizon. It should be for 10 consecutive years so that it can capture the entire business cycle and it won't unfairly penalize the cyclical companies. The third filter is the performance filter, which is the most important. The revenue growth should be more than 10%, and this is because the average nominal GDP was was 14.5% at the time of the book, and now it's 10.4%. So 10% is a reasonable measure. The second thing is that the ROCE should be more than 15%. And this is because at the time of the book, the risk free rate was 8%, the US equity risk premium was at 2%, and India's equity risk premium was 2.5% due to India's triple B rating by S&P. Now the numbers have changed. The risk-free rate is now at 5%. Is at 6%. US's equity risk premium is at 5%, and and India's risk premium is at 2%, which gives us 13%. For financial companies, the measure is different because they don't have revenue or they don't have ROCE either. So we use a loan growth of more than 15% and we use the ROE of more than 15%. We use ROE instead of ROA because we want to be able to measure the returns that a company can earn based on its given equity share capital. The second theme is the long-term investors checklist. So this is a checklist to evaluate the businesses and not stocks. This is a more qualitative measure, while the previous slide was a more quantitative measure. So first we look at the industry attractiveness. The industry sets the ceiling for how much a company and the management can actually reach up to. So it shows the potential. It should be a non-cyclical and a lowly regulated industry so that the returns are not fluctuating. It should also allow for high value addition so that the company can earn has enough pricing power and has greater margins. So its ROC will be better. It should also be a capital light industry because the ROCs for capital light industries are much higher, like sectors like IT and FMCG. It should also be a high growth industry so that it can allow for all competitors within the space. Mature and slow growth industries tend to have much more price wars, which reduces the ROC. And the ROC of the entire industry should consistently be above 15%. The second thing is the management. So they should have clean governance and transparent accounting. A way to measure this is through different ratios. So one of the most important ratio is CFO before taxes upon EBITDA. This can check if any fake sales are being made. The management should also have a focus on the core business. They shouldn't make any unrelated diversifications that bring down the overall ROCE. The capital should also be rationally allocated because investors only get the returns when the ROCE is more than the cost of capital. Finally, we have the IBIS mode, which shows the sustainable advantages that a company has so that they can maintain the higher ROC as compared to their competitors over a long period of time. So the first one is innovation. And innovation is the weakest one because it's really expensive to maintain and competitors can easily copy it. It can be supported with a strong architecture. The second one is the brand, and it shows the trust that the consumers have. And also the pricing power of the company. So you can measure this by seeing the price premium that they charge as compared to its competitors. Architecture is the relationships that the company has with its dealers and suppliers and employees and customers. So we can measure this by seeing the attrition rates of the employees. Lastly, we have the strategic assets, which is the easiest mode to measure. It's basically the intellectual properties like the patents, the contracts, the licenses, and the natural resources that a company has. For example, Tata Steel had its captive mines, which allowed it a low-cost advantage. The second theme is the third theme, sorry, is the returns to the investors. So as you can see, if you invest 1 rupee in Asian Paints in April 2007, then it would now be worth 36 rupees. And to also see the risk adjusted return, we can look at the Sharpe ratio, which measures the excess risk that you get, the excess returns that you get over the risk-free rate for the excess risk that you take. So a higher ratio is always better. And as you can see, Page Industries and Asian Paints has a much higher ratio than the Sensex, which indicates that it might be a better investment. Now I'll hand over to my teammate Vasuraj.
Thank you, Saanvi, for such a great presentation. You can have a slide, you can see the why behind every business success. Opportunity isn't random. They are formed by specific triggers that disrupt the state of the environment of the business at that time. Looking at the top left of my slide, you can see external shocks such as World War II, temporary import and ban, which forced the company like Asian Paints to fill the domestic supply gap. It is followed by the economic liberalization of 1991, which have a trigger to the entry of global banks and brand like consumption, which is a major cause for the formation of top private banks like HDFC and Axis as of today. As people life changes, income increase, and urbanization, there is a shift from industrial to decorative one, and there is a demand from branded FMCG goods, which help the company like Marico and Asian Paint to increase their revenue. In the financial sector, there is a major shift comes the structure banking shift changed the game as a low cost deposit and rapid retail sales are the primary driver for the bank like HDFC. On the top right, you can see the technological and material evaluation. There is a shift from choroid GP pipes to CPVC, which helped the company like Aster to become a dominant player in that segment. As on a human level, rising health awareness about health, lifestyle and health creates an entire new market in preventing care, which helped the company like Marico's premium edible oil Safola to become a dominant market leader at that segment. Finally, regulation and industrial structure become ultimate trigger for business. Businesses often have a greater advantage in lightly regulated sector such as FMCG and paint industry. Now, second slide. Opportunity identification. Opportunity identification is the art of finding the gap in the market and turning that gap into a multi-bagger compounding success. When we see the big corporation as of today, their dominance start by solving very specific, often overlooked problem. So, in my first slide, it covers the mid 20th century from 1950s to 1990s. Between 1950s and 1960s, Asian Paints identified two major white space in their segment. The first is a shift from industrial to decorative one, which leads to brand like consumption and repeated sales. And they ignore the urban distributor to build a rural direct reach and treating dealer as their true partner. Moving into 1960s to 1970s, you can see the power of culture consumption as in rural areas there is a during the festive season there is a paint they paint the bull horns during the festive season, which create a massive demand for Asian paints. By introducing 50 to 100 ml small package, they create a premium product accessible by the masses. Now moving into from 1917 to 1960s, we can see I can see the company like Marico also for the same playbook. They shifted from commodity oil to branded FMCG, focusing on packaging and distribution to gain pricing power in that segment. They focus on this area was also defined by portfolio segmenting, balancing a premium product Safola with a mass use product Sivakar. It says that if you make this decade prove that if you make a product that people actually like, you can create a brand that lasts for generation. Now, second slide. In my second slide, you can see I have covered the era between 1990s to 2000. In this area, the opportunities are more complex. So from 90s, between 90s to 2000, companies like Page Industry and Berger Paints identify the aspiration gap. As India liberalized, there is a spark for premium innerwear and emulation. Between 1994 to 2000, this company also shifted from unorganized commodity market to a highly mind-share premium position at that market. There is a shift in infrastructure and banking segment also. Between 1995 to 2000, companies like Estel Player avoided the crowded PVC market and focusing on CPVC plumbing segment, which make the dominant position in that segment. And Axis Bank also focused on unleveraged current and saving account deposit and retail lending, which was underpenetrating at that time at only 20% versus its peer to sales rapidly. And finally, looking at 2012 to 18, there is a rise of HDFC Bank and the introduction of fintech. This era was defined as a creating a turning threat into tool by introducing the wallets and digital lending into the traditional banking system. The takeaway from 18 milestone uh, is that if you identify the trigger first, the winner is the one who identifies the trigger first and convert it into a multi-bagger compounding success. Thank you. Now my friend Asmira will tell you about business strategy and innovation.
So this slide explains core business strategies followed by successful companies in unusual billionaire. First is focus. They focused on core products to improve. They focused on core products that leads to long-term success. For example, Marico transformed its simple product coconut oil into a strong brand such as Parachute and Saffola. Then we have long-term thinking. Companies like HDFC Bank, they does not choose a quick profit. They followed a profitability first strategy. Because of this, they become India's strongest bank. Then we have FMCG business. They use advertising and packaging to lower entry barriers. Then we have banking sector. They followed profitability first strategy, expanded into semi-urban and rural areas. For an example, Axis Bank moved from aggressive lending to a disciplined risk control strategy to ensure sustainable growth. Next slide. In this slide, we can see different sectors of business strategy. First, we have paint sector. They focused on aggressive advertisement and dealer support. For example, Ancient Paint used heavy advertisement and a strong dealer relationship. Then we have garment sector. They avoid price wars and protected brand value. For example, Page Industries focused on premium positioning and in-store visibility. Then we have piping sector. They have deep ties with plumbers and a core piping focused with wide dealer. The key insight is that discipline focused on core strength with a long-term thinking outperform aggressive expansion by avoiding large mistakes. Next slide. This slide represents innovation. And it shows that innovation is not one big idea. Companies can grow by small and continuous improvements. They should focus on customers and automation. For example, FMCG business are focused on improving the packaging and distribution, while banks like HDFC Bank they focused on improving technology. Next slide. In this slide, we can see innovation in different sector. First, we have banking. They focused on efficiency and risk control. For example, HDFC Bank focused on digital technology to improve its customer services. Then we have paint sector. They focused on forecasting and improving supply chain. Then we have FMCG firms. They focused on understanding consumer deeply. New products were tested and scaled only after success. For example, Marico introduced Saffola after customer validation. Then we have garments. They focused on product upgrades and improving efficiency. Then we have piping sector. In this sector, the innovation comes from product automation and plumber training. So overall, we can say that innovation is about discipline, long-term thinking, not flashy ideas. Now my teammate Shlok will continue.
Brand and reputation. In the unusual billionaire, strong brand allow companies to charge premium price, reduce demand volatility, and maintain leadership over a long period. Asian Paint has continuously refreshed its advertisement to stay emotionally connected with customer. Berger Paint built premium image through early innovation like designer finishing and strong branding such as silk range. Marico biggest strength is its brand portfolio. Brand like Saffola and Parachute create a strong loyalty and allow premium pricing. Page industry, a jockey around comfort and everyday reliability, leading to very high brand loyalty in a low switching category and have strong in-store dominance. Axis Bank successfully rebuilt its reputation through rebranding from UTI Bank to Axis Bank, focusing on integrity and youth appeal and digital banking. HDFC Bank built one of the India's strongest brand through consistent customer service and trust rather than heavy advertising. Astral Pipes use high visibility campaign and plumber-led branding to establish trust even in the commodity product like plastic pipes. Next slide, please. Uh, Strategic asset. Strategic asset. These assets are not only factory or machines. These include things like strong distribution network, long-term dealer relationship, exclusive license, technology, and even more, etc. For example, Asian Paints and Berger Paints have deep dealer network over many years, which give them a big advantages. Big advantages. Berger Paints has Berger Paint has a centralized ERP supply chain, improving efficiency and dealer loyalty. Medico distribute reach, helping launch new product with much lower risk. Page industry benefit from controlling it manufacturing end to end and from it exclusive jockey license. In banking, Axis and HDFC Bank both get benefit from large deposit base, strong transaction banking and customer data. Axis Bank started move towards data-driven analytics to drive retail lending. HDFC Bank, the bank advanced technology platform and customer data enable a strategic asset like 10-second loan, pre-approved loan, helping it stay competitive against fintech players. Astral Pipes has built strong entry barrier through it, Lubrizol partnership and plumber network pan India manufacturing. So strategic asset are what protect great company from competition and help them sustain very high over the long period of time. So next slide will be explained by our team member Ziyan.
Hi, my name is Ziyan. So my topic is organizational architecture, which simply means how structured a business should be. So firstly, starting with Asian Paints. The business invested early into professional management, independent director, and a process making decision makings and a great technology. Meanwhile, Berger Paints had us focused more on standardized, high quality training and a deep dealer relationship, which simply helped them strengthening their distribution channels and also building a great brand trust over years. On the other hand, we can see Marico having an open, empowered, and an independent board directors and a middle strong management, which simply reduce the dependability on founders and also help them creating a long-term value creation. And we can also see Page Industries, which having a strong manufacturing discipline and a direct distributor control, which ensure them consistency even though the growth was gradual. On the other hand, we can see Axis Bank, which struggled initially in their years because of the limited branches and a weaker retail presence. Meanwhile, the greatest and best example of the slide is HDFC Bank, which clearly invested more into systems, policies, and the best of them was the risk management policy, which ensured them an institution which can grow gradually and safely over the years across all cycles. And lastly, we see at the Astral Poly, which succeeded due to their deep relationships with plumbers, with their suppliers, and the distributors. So we can make out that great companies are built through institutional strength and the people and culture. Next slide, please. So, in this slide, I'm going to talk about management leadership and some of the mistakes. So, on the left side of the slide, we can see that some leadership qualities, starting with reliability, which simply means to building a trust over years through consistent quality. And the business must focus on the core business and should not poke around other segments. Then comes a discipline concept, which simply means the business should stay and ahead of focus of a long term view, even if it means sacrificing the short term goals. And a business must reinvest their profits very carefully and have a conservative debt and balance sheet system. And a business must have a strong leaders and a professionally managed system. And finally comes the market understanding, which clearly means to understand the real customer, value perception, and where the company truly belongs. So business would go around other sectors where they can deteriorate their profits. And on the right side of the slide, we can see some of the mistakes, starting with pricing misjudgment of Page Industries and Astral Poly, where we can clearly see that even a strong product can fail if the prices are really high. And then comes the targeting error of Axis Bank and early HDFC Bank, where Axis Bank targeted mid corporates instead of they should have targeted blue chip stable companies and retail consumers, which increased their risk. And HDFC Bank delayed the retail focus, which increased their cost. And then comes the poor execution of Berger Paint. Even though the profitability and growing industry, weak execution, poor cost control, and inconsistent strategy limited their profits. And then comes the government conflict of Asian Paints, where we can clearly see that promoters dispute forced them to sell their stakes to their competitor, which was later reversed at a higher cost. And finally comes the topic of capital misallocation of Marico, and we can clearly get an example that a great industry, profitable industry, can underperform if the capital allocated to them is really low. Where we can see in Marico, consumer business generated the most of the profits but received the minimal capital allocation. So we can make out that great companies are built through discipline, leadership, and leadership compounds slowly, but mistakes compound faster and can erase the long-term value. Thank you. Now next slide will be explained by Heet.
Thank you, Ziyan, for the great explanation. So, hi guys, my name is Heet gotawala, and my topic is capital allocation. So, the first is sensible growth approach. These companies don't chase sales growth just to look big. They focused on real sustainable profitability. Like in example, Asian Paints consistently allocates capital to strengthen its core decorative paint business rather than the unrelated segments. Second, focused capital allocation. Most of their capital is used for genuine business growth rather than just maintaining the daily operations. Third one is the lean and outsource model. By outsourcing smartly and keeping operation lean, they control cost well and ensure the profits go faster than the investment. And fourth one is the prudent borrowing policy. Means they only borrow when the cash flows are stable and when returns are clearly expected to be higher than the interest cost. Fifth, the balanced philosophy. They treat debt carefully, knowing it can support growth if used wisely, but can become risky if the handled poorly. So, sixth one is the asset light strategy. They avoid building heavy factories and unnecessary assets, so the business stays efficient and flexible and easier to manage. In example like Marico, the FMCG firm deploys capital mainly within core products where the margins are high and the growth opportunities are strong. So the next slide will be explained by my teammates, Smit. Thank you.
Capital allocation simply means how a company uses its money. Every company has limited capital, but opportunities are unlimited. So, if money is used in wrong way, even a good companies can fail. The main goal of capital allocation is very clear. A company should invest money only where it earn higher return than the cost of capital. If returns are lower, value is destroyed instead of created. Capital allocation helps a company to stay profitable and remains financially strong. It decides whether money should use for expansion, new projects, technology, or return to shareholders. But when company invest in unrelated areas without proper knowledge, returns often and profit suffers. Another reason capital allocation is important is because it protects the balance sheet. Too much debt and poor investments can put even a big company in troubles. In simple words, capital allocation decides whether a company becomes stronger or weaker over time. That is why capital allocation is one of the most important jobs for top managements and key reason behind a long-term success. Sanvi, can you please do? This slide shows how a strong company deals with disruption. Disruption here does not mean only new technology. It also means cost pressure, tough competition, and changes in how customers behave. First, many industries like paints and FMCGs are highly competitive and price driven. Labor costs have going up a lot, but pricing are increasing slowly. This puts pressure and margin and forces companies to rethink their business model. Secondly, exclusion and technology have become very important. Manual planning is no longer works. Companies need good system data and storage supply for change. Asian Paint is a good example for it. It disrupted itself by using better technology before the competitors did. Third, competition has increased everywhere. We see MNCs challenging Indian companies and global trends like DIY and private labels. Only companies with strong exclusion survive in such an environment. What successful companies did different to show our right to show on the right side. They forced they focused on culture, strong systems, close relationship with dealers and customers, and fast exclusion. They were even ready to accept short-term pressure if it helped to a strong environment. The key learning is simple. Long-term advantage does not come from idea alone. It came from culture, system, relationship, and consistent exclusion. Thank you.
Okay, so this is the end of analysis. Thank you so much for watching.